Rule breaker mailbag item number 1. First up this month, Surinder Punya. Dr. Punya, thank you for your note. David, I'm a big fan of financial literacy. You say I've been educating myself by reading books and also listening to the podcast. I am reading the book 100 to 1 right now. I haven't read that myself. Just finished reading 25 Years of Buffett Annual Letters. Dr. Punya, I've also not done that myself. I actually get excited. You go on each week and look forward to the daily and weekly podcasts, including Market Foolery, Industry Focus. These are all Motley Fool podcasts. Thank you. And of course, Rule Breaker Investing. This is very kind. You are my hero. Thank you for your invaluable service that you provide. I wish I had joined 10 years ago. I did come across the service, but the name kept me away. I am such a small f fool. That does happen, by the way. The Motley Fool name doesn't exactly suggest Schwab-like, Vanguard-like trust to people. And some people think that we're just kind of joking until they eventually look a second or third time or a friend mentions it to them. Anyway, you say, I finally took the plunge a little over a year ago. I'm glad I did. Glad to be a capital F fool. Can we have a commentary on IPOs? There's a flood of them coming each week. Fool on. Sincerely, Surrender. Well, I guess I want to say 3 quick things about IPOs. The first is, I want to make sure that we're all clear on what an IPO is. So IPO stands for the phrase initial public offering. And that's basically when companies that were previously private, started by an entrepreneur, probably venture capital backed or sometimes family money backed, company gets big enough that it decides it wants to sell a portion of itself to the public at large through the New York Stock Exchange or the NASDAQ or another exchange, sell a portion of itself to you and me, armchair investors, and we can become part owners of that company too. The company is born on the public market. So day one, when a company IPOs, yes, it's a verb too. Doesn't really make that much sense, does it? Initial public offerings, day one, when it IPOs, that company has a ticker symbol and it becomes a stock. And you and I can buy it. So number 1, just wanted to define our term and make sure we're all clear on what an IPO is. Point number 2, none of us has to buy them. Not one of us ever has to buy an IPO. Rarely have I ever bought a stock within the first day, let alone month, that stock came public. I wouldn't say I've never done it. I'd have to search my memory. I've been investing for 34 years now as an individual investor since taking over my own account at age 18. I don't think that I've ever bought a company on the first day or two of it being traded. In part, that's because those companies tend to have their stocks, if they're good companies, zoom way up. There's a lot of intense interest, especially, as Dr. Punya is mentioning, in this time where you're finding out about Zoom coming public and Lyft coming public and Uber and Slack, I think, might come public here in 2019. And the list goes on of interesting companies. Beyond Meat, I think, is going public in 2019. So there are a lot of interesting companies that weren't going public in 2018, 17, or 16. There's a little bit of pent-up demand for whatever reason. A lot of them are going public this year, and there's news stories around them, and their stocks typically come out, and Zoom, just like Zoom's IPO did last week, the stock up 70% in one day. But one of the reasons I don't typically buy them at IPO is because you and I don't get that 70% gain. You hear the news say the stock was up 70%, but what's actually happening there is the company gaps up on the opening. It had an intended opening price, but from the first second of trading, buyers have bid it up, and so instead of a company, I'm making this up, coming public at 30, all of a sudden, first trade will be at 42. And you'll hear, wow, that stock's up more than 30%. Nobody profited as a public stock market investor from that. Only the people who owned the shares the day or week or 3 years before, the founders of the company and the venture capital, like only those people own the stock at 30 or below that. Everybody else is starting to buy it at 42. And often, within 6 months, those stocks are back down to where they initially traded or lower than that, studies have shown. So point number 2, you really don't have to buy any IPO. And in fact, here's a little mental exercise I like to go through, and I did this recently on this show. I started to suggest, what are some other stocks you could buy instead of that IPO? I often can find companies that I like just as much, if not more, that are surer things in my mind than some of the new births that are occurring on the public markets. Not to say you shouldn't be excited about a great company like Uber or an interesting IPO like Beyond Meat, but it is to say you and I don't have to buy them. We can do really well as investors without getting caught up in that IPO hype. And then point number 3, if you are interested in an IPO, and I mean, I love it when a cool new company that I'm interested in is born in the public markets. I was really fascinated by Match Group when it came public a few years ago. It's been one of our better stock picks. I would say this, consider just buying a small initial position and then maybe add to that over time. And you know that we like to add to our winners. We don't so-called double down on our losers as rule breaker investors, but consider that. So you can toe dip. You can just start with a small position, and then if you like how the company's developing, then maybe go from there. Now, oh my gosh, is it Bill Mann, the global director of small cap research in Fool Studios?
I snuck in. How are you, David?
You didn't sneak in, Bill, because I mean that really understates. We laid out a red carpet. We gave you free Starbucks.
That's true.
And it's an honor to have you. You were here just a few weeks ago, and I have a mailbag item that was spawned by that. But before we get to that, fantastic. Bill, I want to just ask you, any quick thought from you on IPOs?
Yeah, I think a lot of people get very excited by them. I mean, obviously it's an event, but the thing that you have to recognize about investing is that once a company comes public, it's public until you'd want to say forever, but until it goes private or whatever. So there's plenty of time. And one company that we all know and love is Pinterest. And one thing that I like to point out, just thinking about Pinterest, for example, is that when it came public, it popped and then the stock dropped a lot because I think they struggled a little bit by virtue of now being in the light of having to report quarterly. And so companies really change a little bit once they've become public. So never feel like you're missing out on a publicly, on a public offering simply because you've missed the IPO.
You know what's funny? Here's just a quick analogy, Bill, thinking about, this is not taking a shot at Pinterest, a company I admire, but no, it's just more the humor around IPOs. Are IPOs kind of like new cars? They're really shiny. As soon as you drive them off the lot, seconds later, they're down 30% a lot of the time?
A lot of the time they are. You have to be pretty lucky for it not to drop at some point. I mean, the great news about most IPOs, or a lot of IPOs, is that they don't keep going down like your shiny new car. But
fortunately, Facebook did come back, and I know there's a lot of Motley Fool money long-term riding on a company like that, where we waited for it to drop some and then bought.
That's right.